Two funds for life. What if you could pick two index funds in 2024, 2025, whatever year you're watching this, and buy and hold them forever? The first of these two funds for life is going to be one of my favorite index funds, and that's the US Total Market Index Fund. At Vanguard, this is going to be VTSAX. Fidelity, it's going to be FSKAX or FZROX, and at Schwab, Charles Schwab, it's SWTSX. But for this example, for today, we're going to be using VTSAX as our case study since it is the oldest fund of these four. As of recording this, VTSAX is trading around $114, $115 per share and has an expense ratio of 0.04%, which means for every $1,000 that you have invested in this index fund, you're only going to get charged 40 cents annually. And if you ask me, that's a pretty good deal. Now, Vanguard actually created VTSMX in 1992, which was the original US Total Market Index Fund, but that fund has been closed to new investors. And so we have VTSAX today, which was created in November 2000. Thankfully, we still have the data for the performance of the US Total Market Index Fund dating back to 1992. So we still have a good bit of history on this. But since April 1992, the US Total Market Index Fund has had an average annual rate of return of 9.75%. So if you had an initial investment of $100,000 in this fund in April 1992, today you'd have a bit over $2.1 million without having added anything on top of it. So this fund is the Total Market Index Fund. And what this means is that through this fund, you're buying a piece of just about every single publicly traded company in the United States. With VTSAX specifically, each fund you buy is giving you exposure to over 3,793 different stocks. Now, Fidelity and Schwab are the same, maybe a difference of a few hundred, maybe 1,000 stocks, but generally performance should be about the same because of how these index funds are treated. Something important to note along that line is that a little over 25% of this fund is buying 10 stocks. And that's because funds like the US Total Market Index Fund and S&P 500 index funds are market cap weighted so that more of what you're investing is actually going to go to the bigger companies. The remaining 75% actually get distributed to the other S&P 500 companies and an additional 2,000 to 3,000 different companies that could be in these different index funds. And like I mentioned, from Charles Schwab to Fidelity to Vanguard, these funds could have anywhere from 2,600 companies to 4,000 companies. And you can always check on that information when you're doing your own research by looking at usually the composition tab or composition section that is in that index fund on the different websites of these brokerage firms that you would go and do your research in. This section, that section gives you a lot of great information. And if you want to go over this in the future, let me know in the comments section below. By far, the US Total Market Index Fund is my favorite index fund to hold in just about any account because it's great for taxable accounts. It's great for tax advantage savings accounts like 401ks and IRAs because of the low expenses, and there isn't a lot of taxable activity going on in this fund. And not only that, you're getting a lot of good exposure to different companies out there. So you are getting some diversification within your investment portfolio. So now you might be wondering what the second fund in this two fund portfolio is. And I actually have three to present that I think would be a great fit for those of us in our wealth building, wealth accumulation phase of our lives. And we'll start with number one of that second index fund that you would pair with VTSAX or the US Total Market Index Fund. And that's going to be your small cap value index fund. Since the Total Market Index Fund is weighted toward larger companies, having a small cap value index fund or even a mid cap value index fund could be a great way to get more exposure to those US companies that you otherwise would not have with the Total Market Index Fund. Historically, small cap value has outperformed the total market and the S&P 500. It could be anywhere up to 2 to 3% annual average rate of return. But with that higher level of return, the low years are going to be very low and the high years are going to be very high generally. So if you can stomach this kind of performance, stomach that up and down of having a little bit more of a risky investment like a small cap value index fund, then adding some exposure to that fund could serve you well. Now, a second great option to pair with your US total market index fund, well, is going to be the rest of the world in your international market index fund. This is what I have in my 401k. Overall, I personally like having exposure to the international markets, even though they haven't performed as well when compared to the US, but it is still part of my strategy and will continue to remain a part of my strategy because there will be years where the international markets are going to outperform the US. It's happened in the past, and there's a good chance it's going to happen in the future. Now, your third option to pair with the US total market index fund is going to be different than the first two, and that's going to be a real estate index fund. This index fund is one that I know some of my friends like to own because they're not big on physically owning properties, but through an index fund like this, you can get exposure to companies that buy office buildings, hotels, and other real estate property. Now, I'll tell you straight up, I tried owning property in the past and quickly found out that it wasn't for me, but owning a real estate index fund like Vanguard's VGSLX or Fidelity's FSRNX is an opportunity for people like me who don't want to get involved with the physical aspect of buying, selling, owning, renting, to get into the real estate market and just be able to have that index fund in my investment portfolio. So my question to you is, if you had to go with a 2-fund portfolio, which of these 2 funds are you going to go with? Let us know in the comment section below. And by the way, if you have a 401k, there are 5 mistakes that I really want you to avoid. Check out the video on the screen and I'll see you over there. Peace.